Arun, I'm going to ask you to do the difficult job of analyzing a few of the things that we've seen in the recent past. Um, One set of investor behavior, and I'm certainly not implying that this is all investor behavior or your investor behavior or Ritesh's investor behavior, but one set of investor behavior seems to cover the following ground. Very fast paced, outsourced kind of due diligence, a kind of participation frenzy in late stage fundraisers. Um, Both of these lead to potentially inflated valuations. Um, a scenario where, you know, startups and investors have already agreed on what the valuation should be, and the valuers are kind of working backwards to justify that. And when they do that, the management is giving them fantastical projections. So now this is one scenario, Arun, that I've described. And like I said, I'm sure it's not the case for all startups. I'm not sure if it's the case for majority as well. But two questions to you. Is it a common phenomena? How common is it? And what are you doing differently, or what would you advocate doing differently?
Yeah, I'll try answering it. I think we should first bifurcate that at the early stage, where I think a lot of us on the show are in, try to participate. These are angel rounds and pre-seed rounds. I think diligence is more so, who the founder is, what they stand for, what are their credentials, where did they work previously, right? It's a bet on the person, right? So I think that is the same, whichever point in time you want to do early stage. I think the question you're asking is more on sort of growth stage companies. And at that point, how do you set valuations in that case? I would say, look, it is a bilateral negotiation, right? And and it's just a demand and supply equation. If there's just too much demand for your company, the price just goes up, right? However, what I would say is different is that, you know, the whole point of diligence when you want to do a growth stage investment. I think in 2001 there was just a lot of FOMO in amongst a lot of growth stage investors and hedge funds and a lot of people who wanted to invest in India without actual physical presence in India to understand the market, perhaps, right? So the only way you could differentiate yourself, see, capital became a commodity, right? And the only way you could differentiate yourself is how badly you wanted to be in that company and do that deal. And the price started getting sort of bid up, right? Now, once you start bidding up the price, right, you don't really, you know, go into the diligence reports with a magnifying glass, perhaps when the market is hot,
Hmm.
right? Now, I've also seen the converse, right? I've seen a situation where a, a high growth company, had a term sheet from a growth stage investor, was very active at the time, but then it just was not making sense because the public market valuation started dropping in the US and it didn't make sense to pay those multiples anymore. Now, as a founder, you had made your plans based on that money coming in. Now, what ended up happening in that situation was the fund basically was backstopping the diligence that gets done by a third party, and then that, because of who's paying who and who has what incentive, the the funding was pulled off for a reason that would not have happened a year and a half before that or a year before that, right? So what I'm trying to say is that, while valuations are set, it just feels that, for me at least, in what I've seen, the whole process is a function of how badly somebody wants to be in the company and how badly they want to get out of that deal as soon as possible. And I feel like those levers were there with the investors who came in, and founders were just taking what perhaps the market was offering them, right? And they made their plans based on that. So it's a tough one. Some people were able to pull this off and raise money just before the market collapsed. And they are now making the right decisions to stabilize in a market where they may not be able to raise money. But there are some founders who just didn't get that timing right, and they got the short end of the stick. right? So I wouldn't say it's a bilateral agreement to set the price higher. It's just, how much money was available and how badly people wanted to chase those few companies.